Have you ever wondered if the rules shaping Wall Street and retirement accounts are actually protecting you or holding you back? Imagine being told your 401k can only invest in stocks and bonds, while massive government pension funds have access to private equity, real estate, and even venture capital. Wouldn't you feel like the system is stacked against the everyday worker? That's exactly what's at stake as courts, regulators, and lawmakers battle over new rules for retirement accounts, short selling, and even cryptocurrency. These decisions are not just technical policies. They could affect how your savings grow, how your retirement is funded, and even whether your future investments are secure. In today's video, we're diving deep into recent shakeups at the SEC, new executive orders from President Trump, and what all this means for your money. We'll cover why courts struck down certain Biden-era rules, how 401ks could soon have access to new investment opportunities, and the fast-moving push to regulate crypto in a way that could finally bring clarity for everyday investors. Stick around until the end, because these changes could alter the financial landscape for millions of Americans. And before we jump in, make sure to hit that like button and subscribe to Social Security Post, where we break down Social Security, retirement, and financial changes in plain English so you can stay ahead. The first major change comes from a powerful ruling by a federal appeals court. Judges struck down two big Biden-era financial rules, one on short selling and another on securities lending, saying the SEC failed to properly analyze their economic impact. To put it simply, the court found that the SEC had cut corners. They approved rules that were deeply interconnected without studying how they would affect each other. Short selling and securities lending are closely tied practices, yet the commission treated them as if they were unrelated. The court said, "No, you can't regulate this way," and sent the rules back to the SEC for reconsideration. This wasn't just a one-off mistake either. The SEC's record under prior leadership has been dismal. Out of 11 rules challenged in court during Gary Gensler's tenure as chairman, the SEC didn't win a single case. That's 0 wins, 10 losses, and 1 split decision. For context, imagine a football team with a record like that. They'd be fired immediately. This weak record has raised questions about whether rules were being made based on ideology instead of solid economics. For ordinary investors, the takeaway is clear. The SEC now has to prove its work and show that its regulations make economic sense, not just political sense. With President Trump appointing new leadership, the SEC is now facing a crossroads. The court order forces the agency to revisit its rules and approach regulation more carefully. Instead of rushing through policies without considering their full consequences, the SEC must perform deeper economic analysis. This means more transparency, better justification for rules, and ultimately, a stronger focus on protecting both investors and the markets themselves. The shift in leadership also signals a broader change in philosophy. Under Trump's appointees, the SEC is expected to prioritize market strength and investor choice, rather than blanket restrictions. This could mean new opportunities for companies to go public with modernized IPO rules, potentially benefiting retirees who rely on stock market growth for their portfolios. It could also mean smarter, more efficient regulations that don't choke off innovation. For investors watching from the outside, this is a sign that the SEC may finally move from being reactive to proactive, ensuring rules actually work in practice. One of the most groundbreaking moves we've seen is Trump's executive order that changes the rules for retirement savings. For decades, 401k accounts, the backbone of retirement for millions of workers, were limited mostly to stocks, bonds, and money market instruments. Meanwhile, big pension funds, such as those run by states and local governments, had access to lucrative markets like private equity, venture capital, real estate, and even commodities. The new executive order now opens the door for private sector workers to gain access to these same opportunities. This is a huge deal because diversification is one of the most powerful tools in investing. Instead of being boxed into the same traditional assets, workers could now have portfolios that mirror those of large institutional investors. Imagine your 401k being able to capture the growth of private companies before they ever go public, or being able to hedge against inflation through real estate and commodities. On top of that, crypto is also being introduced as an option, which could be revolutionary, though controversial. For millions of workers, this represents the potential for better risk-adjusted returns and a stronger retirement outlook. But let's rewind a bit to see how we got here. Back in 2020, under Labor Secretary Eugene Scalia, the Department of Labor issued a letter making it clear that nothing in federal law prohibited 401k plans from investing in private equity or alternatives. That guidance was celebrated as a forward-looking move to give workers more options. But in 2021, under the Biden administration, that progress was rolled back. Officials issued supplemental guidance saying, in essence, that employers shouldn't expose workers to these kinds of investments because average people weren't sophisticated enough to understand the risks. That decision effectively shut the door on alternatives for ordinary savers, even as government pension funds continued to benefit from them. Critics argued it was unfair and paternalistic, essentially saying that workers should be protected from themselves. Now, Trump's executive order reverses that stance, putting control back into the hands of fiduciaries who are responsible for selecting 401k investment options. The big question is whether this will empower workers to build stronger retirements, or whether it could lead to risky exposure if not managed properly. For viewers, the question becomes, would you want access to these investments, or do you prefer to stay with the traditional mix of stocks and bonds? The difference between public pensions and private 401ks is stark. Public pension funds have long embraced alternative assets because they know these can improve returns while managing risk. By contrast, most private sector workers have been stuck with a narrower set of options. With the new changes, that gap could finally start to close, allowing everyday workers to build retirement portfolios that are more resilient and competitive. This expansion of choice is being called a potential game changer for retirement savings. It could mean more growth opportunities, more protection against inflation, and more ways to smooth out market volatility. But it also introduces new questions. How will fees be managed? Will workers truly understand the risks involved? And will employers embrace these options or shy away from them due to legal uncertainty? These are the kinds of debates that will shape retirement savings for years to come. Alongside retirement reforms, the SEC has also launched a major initiative on crypto called Project Crypto. For years, crypto regulation in the U.S. has been inconsistent, often relying on enforcement actions instead of clear rules. This left investors and innovators in limbo, never sure whether a digital asset was considered a security or not. Under the new approach, the SEC is aiming to provide clarity and stability, which could finally unlock broader adoption. At the same time, lawmakers are also stepping in. Bipartisan efforts in Congress have led to the Digital Assets Market Structure Bill and other legislation aimed at creating guardrails for crypto markets. This represents a dramatic shift from the past, where crypto was treated more like a threat than an opportunity. For investors, the bottom line is that the government is no longer trying to shut crypto out. It's trying to bring it into the financial mainstream under a clear set of rules. Crypto regulation isn't just about defining securities, it's about addressing practical issues that affect investors. Custody is a major concern. Who holds your digital assets and how safe are they? Staking and tokenization raise questions about whether traditional financial instruments can or should be digitized. Stablecoins, which are often used as a bridge between traditional money and crypto, also bring up concerns about transparency and reserves. Each of these issues is being debated at the highest levels of government. Since January 20th, the SEC has started issuing guidance clarifying which tokens fall under its jurisdiction and which do not. For those that do, there will need to be rules about custody, valuation, disclosures, and settlement. These aren't abstract questions. They directly affect how safe it is for investors to participate in crypto markets. While challenges remain, the fact that the SEC is working on structured guidance represents a turning point in the U.S.'s approach to digital assets. One of the biggest developments is the potential for banks to finally get involved in crypto. Previously, an accounting rule known as Staff Accounting Bulletin 121 made it almost impossible for banks to hold crypto on behalf of clients. That restriction has now been rescinded, opening the door for major financial institutions to step in as custodians. This could dramatically change the landscape by making crypto more secure and accessible for everyday investors. But the move also raises new questions. If banks get involved, regulators will need to decide what risks they should be watching for. Issues like cybersecurity, liquidity, and compliance with anti-money laundering laws will all come into play. Supporters argue that bank involvement will encourage adoption of new technologies, while critics worry it could expose the financial system to unnecessary risks. Either way, the conversation has shifted. Crypto is no longer on the sidelines, and traditional financial players are preparing to get involved. So, what does all of this mean for you, the everyday worker or retiree? The short answer: more opportunities, but also more decisions to make. With expanded options in 401ks, you may soon be able to invest in private equity or crypto as part of your retirement plan. With better SEC oversight, crypto investments could become safer and more transparent. And with courts forcing regulators to be more careful, you can expect smarter, better justified rules in the years ahead. But opportunities always come with risks. Alternative assets are often less liquid and harder to understand. Crypto, while promising, is still highly volatile, and while the SEC is being pushed to do better, the future of regulation will depend on how well new leaders balance innovation with investor protection. For now, the key is to stay informed and be ready to adapt as these changes filter into the financial system. The financial system is entering a new era, and the decisions being made right now will shape retirement and investment security for decades. The question is, do you believe workers should have access to the same tools as big pension funds, including private equity and crypto, or do you think those investments are too risky for 401ks? Drop your answer in the comments below. I'd love to hear your perspective. And remember, staying informed is your best defense in times of change. If you found this breakdown helpful, don't forget to like this video and subscribe to Social Security Post for clear, fact-based updates on Social Security, retirement, and financial rules that affect millions of Americans. The rules may be changing, but with the right knowledge, you can make sure you're prepared.